on the product. But this price ceiling comes at a cost, as we'll see in this demand and supply analysis. Suppose the supply of petrol decreases due to production problems or a war in the Middle East.
This can be represented by a leftward shift of the supply curve, and the price of petrol might rise from 7 to 10 rand per litre. If the government reacts and imposes a price ceiling to keep the price at, say, 8 rand per litre, a shortage develops in the market. Suppliers produce less, demotivated by this lower selling price, while the quantity supplied no longer matches the quantity demanded. At 8 rand, consumers now demand a quantity of Q2, but suppliers are only willing to supply an amount Q1. This creates an excess demand, or shortage of petrol, equal to Q2 minus Q1. Now this is really significant. The market is now unable to fulfill its normal rationing function, where those who can't afford a product don't get it. Other ways now have to be found to decide how this limited quantity supply to Q1 is to be divided among consumers demanding the higher quantity, Q2.
The inadequate supply of petrol must now be rationed. Now this can be done by a first-come, first-served basis, so those in front of the line will be able to get hold of petrol, and those at the back will either have to go without petrol or else look elsewhere for it. Queues form, time's wasted, and some people end up without getting the quantity of petrol they want, or no petrol at all. Some informal rationing system might develop, whereby suppliers limit the quantity sold to each consumer, or by selling to regular consumers only. So, make sure you have a friend in the petrol business. Now, the government can step in again and issue rationing tickets or coupons. So in order to obtain petrol, you have to have both money and a rationing card, and an incentive for corruption is created. So make sure you have a friend in the government business. From experience, we've learned that a price ceiling imposed on a market where producers have legitimate reasons for raising prices will result in some or all of these problems, which eventually outweigh the benefits of keeping the price down.
In 2007, the government of Zimbabwe decreed that the prices of all goods and services were to be cut by 50%. Failure to comply with this regulation would lead to imprisonment and the confiscation of goods in question. On the day the government implemented these price cuts, consumers stormed the shops to buy up as much as they could at the new lower prices. In a matter of hours, the shops were emptied. The consumers in Zimbabwe were clearly better economists than the government. They knew that this decrease in the price could only be temporary and would result in a severe shortage very quickly, as suppliers couldn't afford to continue production. To explain the persistent shortage that followed, the government claimed it was due to hoarding by greedy producers. They promised to hunt them down and confiscate their goods. Police squads were sent out across the country, but guess what? No goods were found. Suppliers had withdrawn, closing their factories and shops and halting the importation of goods. There were simply no goods to confiscate. And eventually, the government was forced to raise prices again.
One day, some of you will be running your own businesses. You'll be entrepreneurs. Some of you may already have started. And when you start a new business venture, you'll be faced with one big question. What does it cost to run a business? Previously, we learned from the law of supply that if the price of a product increases, the quantity supplied will increase too. And if the price of a product decreases, then the quantity supplied will decrease too. Price plays an important role in the decision of a firm to supply more or less to the market. And the question that business owners have to answer is, why will a firm only supply more of a product if the price of that product increases? The answer will explain what motivates most entrepreneurs, why we have a stock exchange, and will also shine more light on why the supply curve is upward sloping. And in order to understand that, we must first understand how the cost of production influences the decision of the firm to supply goods and services.
Let's start by asking why a firm wants to supply goods and services in the first place. As Adam Smith observed, firms supply goods and services to the economy out of their own self-interest. It's not charity. But what exactly is this self-interest? Well, there are a number of different goals a business might have. Maybe to be the largest firm in the industry, to make the best product, or have the highest sales. What we will assume is that firms not only want to make a profit, but that they wish to maximize their profits. And they will constantly try to find a level of production which results in maximum profit. From this, we can assume then that firms will only be willing to increase the production of that something if it means more profit. So, when does a firm maximize profits? Well, if profit is the difference between its sales of a product and what it costs to make it, then for a firm to maximize its profit, it must ensure that the difference between its total revenue, that's the sales price of the product times the quantity sold, and the total cost of producing that quantity is as large as possible.
The cost of production is a huge factor for any firm in a market economy. We need to understand how firms try to manage this variable, both for this course and for your future businesses.
As we've come to expect, economists often have a different way of looking at things. Before we delve deeper into the concept of cost, we need to distinguish between an accountant's view of cost and that of an economist.
I'm here in the offices of a large accountancy firm to meet with one of its senior partners, Mr. Rainaker.
Hi Greg, nice
Hi
to
there.
meet you. Let's go through to the office.
Thanks very much. Mr. Rainaker also has to analyse cost, but he as an accountant and I as an economist do so in rather different ways. Mr. Rainaker, how do you as an accountant analyse cost?
Yes, Greg. As accountants, typically we define costs as actual expenditure incurred by the company, whether it being for the production of a product or a service, or whether it being for the running of the business as such.
I see.
If you look at a typical set of financial statements, you would typically find the costs relating to the production of the product or the service would be reflected in a section to indicate a gross profit for the business, and then the actual expenditure incurred for the running of the business would be reflected in a detailed expenditure section.
And this typical set of expenses here, what have we got? What are the main
Well,
ones?
typically some of the expenses you might find on here is like advertising, obviously the auditor's expenses, employee costs, lease expenditure, telephone and fax.
And tax?
Yeah, typically tax as well. You can't get away from that
Can't
one.
get away from tax.
Accountants define cost in terms of actual monetary payments for resources or inputs used in the production of goods and services. These are called the explicit cost of production.
But for an economist, cost is more than just the actual money exchanged during the production of a good or service. Implicit costs are usually estimated to be the revenues a business could have made operating in the next best industry. Simply put, implicit cost is the money a business could have made if it were doing something else. The following example illustrates some of the difference between the cost as considered by an accountant and the cost as considered by an economist. Suppose you run your own business and your total revenue from the business is 80,000 Rand, while your total explicit cost is 35,000 Rand. Consider also that if you did not work for yourself, you could have earned maybe 50,000 Rand working for another company.
In the accountant's calculation, the cost of production includes only the explicit costs of 35,000 Rand. When they calculate the profit of the business, it will look like this. Profit equals total revenue less total cost. So 80,000 Rand less 35,000 Rand equals a profit of 45,000 Rand. Economists, on the other hand, calculate things slightly differently. The economist will also include the implicit cost. That's the opportunity cost of being self-employed. If you didn't run your own business and work for someone else, you might have earned 50,000 Rand. Now this represents the opportunity cost of being self-employed. The economist's cost calculation is therefore explicit cost plus implicit cost. So 35,000 Rand plus 50,000 Rand, equaling now a total cost of 85,000 Rand. So when they calculate profit, they'll do it as follows. Profit equals total revenue less the explicit costs and less implicit costs. So that's 80,000 Rand minus 35,000 Rand minus 50,000 Rand. That equals minus 5,000 Rand, or a loss of 5,000 Rand.
As economists see things, you are in fact losing money by running your own business. You'd be better off financially selling your labour to another firm. What, however, is not included in this calculation is the benefit or satisfaction you derive from running your own business. Now, if this satisfaction is worth more to you than 5,000 Rand, keep on running your own business.
This example illustrates the implicit costs of a self-employed resource. That's you, the business owner. In many cases, however, your firm might also own the land, buildings, or the machinery that is used in the production of your product.
These are called self-owned resources. And according to economists, these costs must be included, since we are, after all, interested in all the uses that are made of our scarce resources. So, while the definition of profit as the difference between total revenues and total costs is pretty straightforward, accountants and economists still arrive at different estimates of what it's worth. This is because accountants only consider explicit costs, whereas economists consider both explicit and implicit costs. A good example of an implicit cost is the opportunity cost of self-employment. That is, the amount of money you might have made working for someone else. Now, in calculating your economic profit, economists deduct that possible salary from your total profit.
Consider the following example. Assume you're a mechanic and you run your own repair business from a small workshop on your property. Initially, you spent 50,000 Rand to buy tools and equipment, and after your first year, your total revenue was 230,000 Rand, and your total explicit cost was 120,000 Rand. An accountant would do the following calculation. Profit equals total revenue minus total cost, so that's 230,000 Rand minus 120,000 Rand, leaving a fine profit of 110,000 Rand.
An economist, on the other hand, wants to know more than this when calculating profit.
How much could you have earned if you'd worked as a mechanic for someone else? This gives us an indication of the opportunity cost of working for yourself. Let's assume you could have earned a salary of 60,000 Rand. Now, remember that initial 50,000 Rand that you invested to buy tools and machinery? If you'd put it into a savings account at the bank instead, how much could you have earned in interest? This lost interest is the opportunity cost of that first capital investment you made in your business. Let's assume you could have earned 10% per year, so interest would have been 5,000 Rand. The final thing the economist wants to know is, how much could you have earned if renting your workshop out to someone else? Let's assume you could have earned 1,500 Rand a month in rent. That would have given you 18,000 Rand per year. So, explicit costs, all your monetary payments, come to 120,000 Rand. Implicit costs include the opportunity cost of working for yourself, that's 60,000 Rand, plus the interest lost investing in equipment instead of saving, that's 5,000 Rand, plus the rent you could have earned in the year renting to someone else, that was 18,000 Rand. In other words, your implicit cost equals 83,000 Rand. So your total costs, explicit and implicit, amount to 203,000 Rand. The profit calculation is now total revenue minus total cost, that's explicit plus implicit costs. That's 230,000 Rand minus 203,000 Rand equals 27,000 Rand. Part of the implicit cost is the opportunity cost of being self-employed, and this implies that in the calculation of costs by an economist, normal profits are included. Profit is the reward for entrepreneurial ability, and since we wish to calculate the opportunity cost of producing goods and services, it must form part of the calculation of the economic cost of doing business. In other words, from an economic point of view, when total revenue is equal to total cost, it does not mean that the firm is not making a profit. It means it's making a normal profit only. What about the case where total revenue exceeds total cost, as in the example above? Well, in this case, an economist will say the business is not only making a normal profit, but also an economic profit, which is the additional return to the entrepreneur over and above the minimum payment required to keep the owner's entrepreneurial abilities self-employed. Now we can go on to explore cost in more detail. To explain the cost of production, we use as our example a business called the Blakermarker that makes garden ornaments. We're now going to construct a table showing various ways we can analyse cost. In the first column, we plot different levels of production. We'll call this total product, TP. That is the number of garden ornaments that are produced. It starts with 0 production and then increases by increments of 1,000. In other words, 1,000, 2,000, 3,000, and so on. I'm here with Johan, the owner of Blakermarker.
My fixed cost is the factory, the building, the land, we have to pay rent, taxes to the municipality.
To understand this better, we're going to separate the cost of production into fixed costs and variable costs. We'll first consider fixed costs.
Fixed costs are those that the firm must pay even if it produces no output. They're pretty constant, independent of fluctuations in output. For instance, the Blakermarker must pay the rent for the building, the municipal taxes, contractual payments for machines, interest on debt and vehicle finance, and so on. And it must pay these even if it's producing nothing.
No matter how many or how few units they produce, these costs do not change, and that's why we call them fixed costs.
Let's assume our fixed cost for this business is 20,000 Rand. Now that's indicated in column 2. This cost doesn't change over the year, whether they're producing 100, 1,000 or 10,000 ornaments.
We will now proceed to present this total fixed cost with the aid of a diagram.
On the horizontal axis, we plot the total output, 1,000, 2,000, 3,000, 4,000, 5,000, 6,000 and 7,000 units. On the vertical axis, we plot the fixed cost, and for every level of output, the fixed cost is 20,000 Rand. By joining the points, we can represent fixed costs as a smooth horizontal curve. So that is total fixed costs. Now we must look at something called average fixed costs. Average fixed cost is the total fixed cost divided by the level of output. For 1,000 units, it's 20,000 Rand divided by 1,000, giving you 20 Rand. For 2,000 units, it's 20,000 Rand divided by 2,000, giving you 10 Rand, and so on. These figures are given in column 3. Now note how the average fixed cost decreases as the Blakermarker produces more goods. While total fixed costs stay the same, average fixed costs fall as production increases.
Why does the average fixed cost keep dropping?
Well, total fixed cost keeps getting divided by larger and larger numbers as production increases. In other words, the firm is spreading its fixed cost of 20,000 Rand over more and more units. As more ornaments are produced, the average fixed cost drops.
Now, let's turn our attention to what are called variable costs. Variable cost is the cost that changes as the total output changes. Tell me, Johan, what's your most important variable cost here?
It's labour, inputs like steel, paint, gas, welding material. They're all variable in the sense that they can change in the short term.
As Blakermarker produces more ornaments, it uses more materials, more labour, more of its variable inputs, so variable costs increase as output increases. These costs are given in column 4. We can show them graphically in the following diagram. Looking at these figures, if total output is 0, variable cost is 0, and from there it increases as production increases. At 1,000 ornaments it's 30,000 rand. At 2,000 units it's 50,000 rand, 3,000 units 65,000 rand, and so on. If we draw a smooth curve through these values, we can see more than the obvious, which is that variable costs increase as production increases. We know that. But we can now see that it increases less and less until around 3,000 units, and after that point it starts to rise by bigger and bigger amounts. It's this changing slope of this curve that we have to try and explain.
Let's take a look at what happens to average variable cost.
Average variable cost is the total variable cost divided by the total product, and it's listed in column 5. The average variable cost for 1,000 units is 30,000 rand, divided by 1,000, that's 30. For 2,000 units, it's 50,000 rand divided by 2,000, so that's 25 rand, and so on. Graphically, it's represented like this. Joining the points as before, you can see that the average variable cost curve first goes down, reaches a minimum, and then starts to increase.
Its curve is U-shaped, and it's this shape that we need to understand. But before we do that, we must deal with the total cost of production, and then with an important concept, the marginal cost of production.
The total cost of production consists of the total fixed costs plus the total variable cost. The total cost is given in column 6. If production is 0, the total cost of production is equal to the fixed cost of 20,000 rand, since there are no variable costs. At 1,000 units, total cost is equal to 20,000 rand plus 30,000 rand, giving you 50,000 rand. For 2,000 units, total costs are 20,000 rand plus 50,000 rand, giving you 70,000 rand, and so on. Now graphically it looks like this. The light blue areas represent the fixed cost, which we know doesn't change, staying at 20,000 rand. And the purple areas show the variable cost. Drawing the curve, it shows what we'd expect. Total cost increases as production increases, but like the variable cost curve, it increases at a slowing rate up to a point and then rises faster after that point.
We can now also calculate the average total cost and draw a diagram to represent it.
The average total cost is shown in column 7 and is calculated by dividing the total cost by the total product. Graphically, it looks like this. And drawing a smooth line, we see that it first decreases, reaches a minimum, and then increases. It is also U-shaped, a bit like that average variable cost curve.
We're now going to compare the average variable cost curve with the average total cost curve.
The first thing to notice is that the average total cost curve lies above the average variable cost curve, as we'd expect. Average total cost includes average fixed cost. The area between these curves therefore represents the average fixed cost per unit. Both curves are U-shaped. They decrease, reach a minimum, and then increase. However, the average variable cost reaches its minimum before average total cost does.
Remember, these are all just tools, and you have a rewind button. You'll see shortly how this information helps to clarify the issues relating to cost that all business must understand if they are to survive and grow. Now, let's deal with the marginal cost of production. Marginal cost, or MC, is the cost of producing each additional unit. So in this business, it's the cost of producing each additional garden ornament. To calculate marginal cost, we start off with the total cost data provided by Marker.
For instance, to calculate the marginal cost of the 2,000th unit, we do the following. The increase in total cost from number 1999 to the 2,000th unit is 70,000 Rand minus 69,000 Rand 980. So that's 20 Rand. And we do it the same way for the 3,000th unit, the 4,000th, and so on. These calculations are given in the table. Drawing a smooth line, you can see that it first decreases, reaches a minimum, and then increases. It is this U shape that we must try to explain. Let's look at the relationship between the marginal cost curve and the last two average cost curves, namely average variable cost and average total cost. Notice that when average variable cost and average total cost are falling, marginal cost is lower than both of them. But when average variable and average total costs are rising, the marginal overtakes them. When marginal cost is below our average costs, it's pulling our average cost downward. And when marginal cost, the cost of producing each additional unit, is higher than our average cost starts to increase. The important thing to notice here, and to remember, is that the marginal cost curve cuts both the average variable cost curves and the average total cost curves at their minimum points.
Now that we know how costs change for a business, it's time to explain why it is that the marginal cost of production, that is, the cost to produce one additional unit, first decreases and then increases. To do that, we need to look at what is known as the production function and the law of diminishing returns. Land, labour, capital, entrepreneurship, supplies or intermediate goods, everything that gets used to make this product we'll refer to as inputs, and the garden ornaments that get produced we'll refer to as outputs.
For the Marker, these inputs are the buildings, the machines, iron rods, the workers, even the lights and water. The output is the range of garden ornaments they produce.
The process that changes inputs into outputs is called the production process. And to describe this process, we're going to make use of something called the production function. The production function shows us the maximum amount, the maximum output a firm can produce with different combinations of inputs. The total output of a business, everything it produces, is called the total product, or TP.
Inputs can be classified as either fixed inputs or variable inputs. Things like the buildings and the capital, that's all the heavy equipment and machinery, are what we call fixed inputs. They can't be changed overnight, quickly or easily. These fixed inputs generate the fixed costs of production that we looked at earlier. Costs like rent, rates, interest payments on loans and so on.
Other inputs, like the iron rods and the labourers employed, are called variable inputs because they can change fairly quickly and easily. It's these inputs that are behind the variable costs. The difference between these two types of inputs is important because the amount of fixed inputs affects the firm's freedom to make quick or flexible production decisions in the short run. The difference between a fixed and a variable input is really the difference in the speed at which a firm can change that input.
OK, so now we know that firms can change variable inputs quickly. If Blakermarker wants to produce more ornaments, they need to buy more iron rods and employ more workers. They can pick up the phone, order them, and probably have them available the very next day.
Fixed inputs, however, are not so easy to change. They could build a new factory, but that could take some time. They might have to secure new loans and investment, arrange to sell this factory, find and buy a new piece of land, contract an architect, then a builder, and then, well, you get the idea. It could take months or even years, and that's why when we look at production, we consider two different time periods. The short run is any period of time in which at least one of our fixed input factors cannot be changed. For instance, the size of the building or the capital equipment. The long run is any period of time in which the firm can change any of the inputs, including the fixed inputs. Decisions a firm makes about the long run are called planning decisions. In the real world, production functions are very complicated things. And to try and understand these complexities, we're going to use some of that old economist magic and make some simplifying assumptions. For now, we'll only deal with the short run. In other words, we will assume the fixed inputs do not change and ignore them for the time being.
Now, the law of diminishing returns. This law was one of the first, and is still today, one of the most important tools we can use to understand and plan the production function for any type of business. To understand the production function, we first need to understand the law of diminishing returns. This famous law was established by a Frenchman, Anne Robert Jacques Turgot, who lived between 1727 and 1780. We'll just call him Turgot. He was one of the preeminent economists of the 18th century, a French Adam Smith if you like, although his work preceded Smith's Wealth of Nations by about 10 years. Many historians believe that if the French King Louis XVI had listened to Turgot instead of firing him, the French Revolution may never have happened, and the king might have avoided his abrupt comeuppance. The law of diminishing returns states that as more of a variable input is used in the production process while the fixed inputs stay the same, each additional unit of the variable input will eventually produce less and less additional output. In economic language, the marginal product of the variable input declines. Many of the gloomy predictions made by economists during the 20th century were based on this law. They thought, well, agricultural land is a fixed variable, but the population keeps growing, more and more labour is working this fixed limited land, and because of the law of diminishing returns, the additional food produced by each new farm worker is going to get less and less. Oh my word, sacré bleu! Starvation will follow, life will be brutal and short. It wasn't a very hopeful picture.
Fortunately, these predictions did not materialise due to new methods and innovations in technology in the agricultural sector. Let's see what this law means for Blakermarker. To keep things simple, we will assume that labour is our only variable input.
So, what is the contribution that each additional worker makes to total product? In other words, what is the marginal product of labour to total production? Well, column 1 in our table shows the number of workers. By employing the first worker, they can now produce 500 ornaments, so total product is 500. The contribution the first worker makes to total product is therefore 500. This is called the marginal product, which we'll list in column 3. By adding a second worker, total production increases to 1,500 ornaments. The marginal contribution of the second worker, his addition to total product, is therefore 1,000 units. Now, why is the second worker adding so much more product than the first worker, who only produced 500 units? What we're seeing here is the benefit of specialization. Before the second worker was employed, worker number 1 had to do everything, from fetching the rods, bending them, welding them, painting them, and everything else in between. But now, 2 workers, the tasks are divided between them. Specialization takes place, we have better efficiency, and the productivity of each worker improves. Now, if we add a third worker, average productivity might increase even more. Let's say output increases to 3,000 ornaments. The marginal contribution of the third worker is therefore 1,500 units. Up to this point, we're seeing increasing returns with each new worker. Adding a fourth worker pushes total production up to 4,000 units. The marginal product of worker number 4 is 1,000 additional units.
Do you see what's happening? The marginal product of the fourth worker is less than the marginal product of the third worker. Diminishing returns are setting in.
Using more workers in a limited space like this, we will become inefficient, falling over each other, and it's dangerous.
And as the law says, if we keep adding more of a variable input to the fixed inputs, a point will be reached where each additional unit of the variable input will eventually produce less and less additional output. In our example, this happened when we added the fourth worker. His marginal product of 1,000 units was less than that of worker 3, who added 1,500 units to the company's total production.
Why is that? Additional labour only gets more productive when there's enough space, equipment and raw materials to work with. But in the short run, the Blacher marker cannot change the amount of space and equipment it has. These inputs are fixed. All it can change is the number of workers.
Adding a fifth worker still increases output up to 4,500 units. But the marginal product of the fifth worker is now only 500 units, and adding a sixth only increases total product to 4,750 units. So the marginal product of the sixth worker is a fairly pathetic 250 units. While the factory is still producing a little bit more, this increase in output is happening at an ever-diminishing rate. If they keep on adding workers, they'll eventually reach a point where the additional worker contributes nothing to production. In our example, this happens when worker number 7 is employed. If Blacher marker persists in employing more and more workers, when they add number 8, they'll see total production actually start to decline. In this case, total output drops to 4,500 units.
The marginal contribution of the eighth worker is therefore a negative 250, and we can illustrate this with the help of a graph or diagram.
On the horizontal axis, the number of workers is measured, and on the vertical axis, total output, or total product. As more workers are employed, output increases, but only up to a point, after which it starts to decrease. Drawing a smooth curve through these points illustrates this. Adding more of a variable input, labour in our case, to a fixed input increases total output more and more up to a certain point, and then increases output less and less till it reaches a peak, after which output will start to fall.
Let's see what the marginal product curve is telling us. Using the figures from this table, we can compile the following graph.
Marginal product first increases, it reaches an optimal point, and then starts to decrease, and finally becomes negative. This is very clearly demonstrated by the marginal product curve. With this information, we can now also calculate the average product per worker, and this will give us some measure of productivity. The average product per worker is simply calculated by dividing the total product by the number of workers employed. In the case of one worker, the average product is 500 divided by 1. Well, that's 500. The average product when there's 2 workers is 1,500 divided by 2, which gives us 750, and so on. These figures are given in column 3.
Looking at average product in graphic form, we see that average product first increases, reaches a maximum, and then decreases. And if we compare total product with marginal product, we can see 3 definite phases of production.
Phase 1 is up until point B. Total product grows at an increasing rate, and the marginal product of each additional worker also keeps rising. Phase 2 lies between point B and point A. Total product is still growing, but at a slowing rate. The marginal product of labour is getting less and less with each additional worker, but the total output is still growing a little. Phase 3 is everything after point A. Total product is now falling, and the marginal product of labour is now actually negative.
Looking at these 3 phases, where would the company ideally like to be? In phase 1, 2, or 3? Well, definitely not in phase 3. In this phase, production declines and the additional workers have a negative contribution. That leaves us with phase 1 or 2.
The general principle for most businesses is that as long as total production is growing, even if it's only slightly, it's fine to keep adding labour. In the short run anyway, that's all the firm can do if it wants to increase output. It's only when extra labour doesn't add any more output that it becomes a real problem. Exactly where in phase 2 the best position for the firm is will depend on the price of the product and the cost of production.
The marginal product curve shows the contribution that each additional unit of the variable factor makes to total production. In our case, it shows what each additional worker adds to our output.
From the marginal product curve, we can see that the marginal product of labour first increases, reaches a maximum, and then decreases.
Let's see how this marginal product curve relates to the marginal cost curve.
The marginal cost curve shows us the other side of the same coin. It tells us what happens to the cost of producing each additional unit. It first decreases, reaches a minimum, and then costs start to increase.
Assuming a given price for the product and a given wage for labour, we can now establish the relationship between the 2 curves and so explain the shape of the marginal cost curve. Assuming we pay all the workers the same wage, an increase in the marginal product of labour implies that for the additional money we spend to employ this additional worker, it in fact means that we get a greater output for the money spent. And this then means that the cost of producing the additional unit in fact decreases. As the marginal product of labour goes up, the marginal cost decreases. Now, what happens to marginal cost if the marginal product of labour decreases?
Now, since we pay each worker the same wage, if the marginal product of each new worker falls, it suggests that the additional wages we're paying are producing less and less, so our marginal cost is actually increasing. As marginal product declines, marginal cost increases. It also follows then that when marginal product is at its maximum, marginal cost will be at its minimum. The same relationship can be seen between the average product and the average variable cost curves. We've now looked at different costs and the law of diminishing returns. Remember these because they're useful tools for the rest of your economic studies. And don't forget, you have a rewind button if anything's unclear. market economy. It can be pretty intense, always busy, frantic even, with the constant buzz of buying and selling activity, a dynamic engine driven by a fuel we create, the human desire for financial and material advancement.
This desire most commonly shows itself as the pursuit of profit. Shareholders and stakeholders